Dear subscribers, as you know, we shared many information for you, and we are studying very hard to find current news for you. However, I cannot use this channel for future. Please follow our new channel called as Daily News Report and watch our video to support us. Link in description. Also, you can reach the video we shared on Daily News Report by clicking on the top right button. We highly recommend watching, subscribing and sharing. We will continue to share some news on this channel, but we take precautions against some situations for future. Thank you for supporting us.
He's not making the cut for you guys.
I would just say that actually during the lockdown period, with our rapid immersion into technology, we've probably had no let-up in the number of companies that we've been able to communicate with. Maybe not face-to-face, but in a different sense over a Zoom or a Microsoft Teams. So it's been quite, I think, emergence from lockdown will be quite interesting to see how many flights are continued with travelling executive teams when it's been quite successful in our view so far. When it comes to those meetings, I think that the bias lately has been with sectors that are currently in the limelight and benefiting from higher metal prices. I'd say on balance, the majority of the companies that we've met as a trend have been in gold, but we have had some of the base metal producers and developers also coming through to us. And we've had conversations with the uranium market, which is also coming back into focus with investors with an eye to the potential leverage in that sector. In terms of themes as to which companies make the cut, I would say our preference is for those management teams which have a track record in developing other projects or running them and operating them successfully. We would also clearly look at the project economics of an underlying asset. And clearly we have to, as those companies making the cut have to have an attractive valuation. And those are the three key themes for those companies that we would tend to invest in. As a broad thematic, we like the underpinning safety that attractive valuations offer versus perhaps the larger cap, more liquid investments that typically find themselves in benchmark indices. And our closed-end fund structure gives us that flexibility to invest in companies and equities that would perhaps be classed as too illiquid and therefore have very attractive valuations than would otherwise be the case in the large cap mainstream sector. We've got pretty good relations with management teams that we followed for a number of years. Rob and I collectively have a number of decades worth of contact in that sector. And for preference, we would generally look for projects that have not out-and-out operational leverage where costs are predicted to or be reliant upon higher metal prices, but those which can see some kind of de-risking through adding mine life, but in the meantime have a profitable cost base and are generating cash flow. And that's very much a theme for us. There's probably enough leverage in the sector at the moment just through valuation, given the disparity between this sector, for example, its cash flow yields and the yields offered on the S&P. I'd say at the moment, actually, this broader commodity sector is very much at an extreme discount to wider equity markets, such as the S&P. I hope that helps provide some background as to the sort of themes that we're seeing and the necessary attributes that we would look for.
Absolutely. What role do you think jurisdiction plays in that equation as well? I know that some fund managers don't like to look at riskier jurisdictions. So how do you guys go about assessing jurisdiction for each of those?
That's a good question. It's quite subjective. I would say that the majority of our investments are in the safe jurisdictions of North America, in Australia. I think, though, the natural resources space certainly still has some good, well-managed projects in jurisdictions that we're comfortable with in areas of South America and Africa. There is probably a valuation discount that we would subjectively need to consider within that, but I think so long as there is a reasonably robust track record of governments not interfering too much in fiscal terms on projects, then we can very often become comfortable with those type of situations. Again, as I say, valuation is often helpful in that regard. I can't think of any situations where there's been a particularly, even with the benefit of hindsight, a position where things have escalated too far against us in that regard. Jurisdiction hasn't really created too many problems. We wouldn't tend to go for the Democratic Republic of Congo, which has a slightly checkered, that's probably polite, track record of adjusting its own tax laws. On balance, we would certainly not rule it out. Some jurisdictions, except for the extremes of the DRC, which are checkered.
Absolutely. Keith, as we were speaking before the call, and as you're talking about value and valuations, give us a little bit of an overview on the different valuations and or discounts some of the funds are trading at versus the others.
Yeah, certainly. I think probably one of the cleanest way to do that is to take, for example, the precious metal fund that we run. Gold is quite homogeneous and is perhaps a clearer way to put that in perspective. If we looked at the valuations of the liquid large cap names, say the streaming companies such as Franco-Nevada and Wheaton Precious Metals, those would typically seem to trade, and I would assume a long-term gold price here, say the trailing 3-year average, which is probably as good a base as any, being the SEC's typical sort of guideline of around $1,400 an ounce, then the streaming companies would trade on anything between 2 for Wheaton Precious Metals to 3 times their expected underlying NPV of their income streams. For large cap mining equities, which have associated operational risks that aren't reflected to the same extent in the streaming companies, again, the P to NAV valuation would typically be something like 2 to 3 times. Those are the liquid names. They're in the bigger gold ETFs, the GDX, for example. If we looked below that, the sort of medium producers, the B2 Golds and the likes, they might trade on a 1.5 times to 2 times price to NAV. And then if we look below that, at the spectrum, which is ignored or certainly relatively ignored because of the lower liquidity levels, the small cap producers, they might trade on 1.5 times NAV to 1 times NAV. And if you look at developers, it can be even more extreme in terms of the potential multiple price uplift that you could see from investing in such entities. And I think that's a clear way of providing some perspective on the differential in valuations between the larger, more liquid benchmark type investments and the less liquid opportunities that the closed-end structure that our funds allow us to accept that longer-term nature of that lower liquidity. And that certainly paid dividends with when the gold price is on the rise. Our fund is doing very well year to date. Last year it pretty much doubled. I think, we have latterly seen some of the better performing equity performances rotated into some of the laggard names where, having seen the price move to the extent we have, some have perhaps had an expected equity raise come along, which had been depressing the share price, we participated, and we've had some very good performance out of those. We've taken some positions in Australian listed Silver Lake and reinvested those into slightly higher cost operators such as Westgold, and that's the type of rotation that we have tried to enact across the fund, and it's been paying dividends. Latterly, we invested in another Australian company called Rox Resources, which had ownership of an asset neighbouring one that had been acquired, and that is up nearly 200% in a matter of months. Again, that's now quite a large position for our precious metal fund. But I think that gives you a flavour for the type of exposure that our fund can gain. And it really is a very, very much one now of in the largest position we hold in the precious metal fund called West African Resources. We still love the valuation, think it has further to run, but we have to manage the concentration risk. You know, we're over 10% of net asset value in that one stock, which has done extremely well. And, you know, we are starting to have to consider those type of aspects, even though we still like some of the valuations that they offer. That is a developer which has now transitioned into a producer and is de-risked considerably and is starting to be added to some of the Australian and mining and ETF indexes and benchmarks, which gives you that leg up in liquidity and helps re-rate these stocks. And with prospective news flow still to come out, that's the type of investment that we find very attractive, where we have some catalysts on news flow which will drive a re-rating in its own right, up to the point where previously it was too small to be included into indices. Suddenly it gains further momentum as they gain traction on the increasing size, and it has a compounding effect of improving liquidity, and it can keep the momentum of a stock going for longer sometimes than you might imagine.
When we saw the drop in everything and general equities in March, was that a chance for you guys to rebalance some of your positions, or were you able to capitalize on the cheaper share price of most of these companies?
I have to say that one of the best things we did was to maintain our weighting in gold in the fund. Previously, we were aware that there was a seeming improvement in the underlying economic situation globally. Things appeared as though they were perhaps looking at more of a recovery following some deceleration into the back end of last year. The difficulty that we had in March is that the valuation on gold companies was still so cheap that it was very difficult to rotate. And the outturn is that actually the gold sector has probably outperformed, even though we have had some fiscal stimulus, the industrial metals. I think we are now at a point where we're considering again whether or not we should be looking at some of the industrial aspects to that. In, for example, the gold sector, I think there's a good reason to think that we could further increase the silver exposure of that fund. Silver has over 50% of its demand from the industrial sector. The other 50% is typically for jewellery, and that has lagged in terms of the sentiment effect, the improvement in the gold price that we've seen, and it has the benefit of the potential recovery in the electronics sector. You know, we look at things like the gold-silver ratio, which peaked at something like 124 times. So you could buy 124 ounces of silver for every ounce of gold. That's a record. It's since retraced to 100, but that's still very much at the top end of an historic range. Again, that's subjective, but I think in terms of providing a potential perspective on the risk reward of investing in that, we could still increase the precious metal fund's exposure to silver beyond the 20. It's currently about 1/4 silver, and I think we could see that rise a little bit further. I think in terms of the industrial demand, we've seen stimulus being provided by the EU in particular, which is trying to issue green bonds, which will drive photovoltaic demand. That in 2019 was a large source of demand for silver units that grew 7%. I think we've started to see some tentative signs of recovery in the automotive industry. Typically, even smaller cars will be using something like 30 grams of silver in each. And of course, we've got a general electronics thematic, which is probably capped off by the acceleration in the rollout of 5G, which might see silver demand from that sector increase from, if you look at the Silver Institute, perhaps 7.5 million ounces up to more than doubling, perhaps trebling out to 2025, depending on the pace at which it is rolled out. So I think, that is a metal that we would look to in terms of the recovery and a rebalancing of the portfolio as it stands generally. But copper is going to see a benefit. I think that we are still very much in the electrification mode, and the gold to copper ratio is also looking now perhaps in favour of things like copper. There is a case that perhaps in the broader growth and income fund that we might rotate some of the gold exposure and precious metal safe haven exposure into that. We'll assess on a day-by-day basis, but that is in the thought process at the moment.
One other thing I'd like to touch on is the oil supply demand picture going forward. Obviously, we've seen in the last couple months oil, just the price of oil anyway, collapse. Going forward, what do you expect to see for the supply side of the equation and the demand side? And let us know a little bit about the shipping play on that as well.
Yeah, we have been cautious of the oil industry, which over the last period has been transformed by the advent of on-land shale production in the US, which has become very much a relatively quick manufacturing process versus the historic multi-billion, huge upfront capex endeavor that it previously was, such that now in the States, supply can be brought on very quickly indeed, 18 months, perhaps less in some instances. It's a process which has swung the balance of power in favour of the US as the swing producer, which prompted in large part the change of strategy of OPEC to actually go for market share. Having tried to hold the line with quota reductions, it effectively realised that it was giving market share to the US. And as the US pipeline completions were kicking in, it used its last moment of leverage in which to change strategy to go for market share and pump as much as it could. That has clearly seen quite a strong response in terms of supply reduction, coinciding as it did with such a demand shock on the demand front. But there's been a very rapid reduction from the unprecedented negative WTI price up to something near $40 a barrel as it stands today. And at that sort of level, our view would be that the balance will be somewhat restored. I think for choice, we would go for activity-related exposure prior to this, rather than own the energy sector per se. We instead were more comfortable investing in shippers, particularly those with newer fleets that had vessels that were compliant with incoming shipping standards for emissions. Were given an additional boost, a very substantial boost, by being chartered for offshore storage of oil production. And we're starting to see some very decent dividends being paid by those entities. For choice, now that we're starting to see, I think, a bit of normality return, whilst we've had a day rate reduction from the unsustainable levels that we saw during the negative WTI debacle, I think we still have an attractive industry which should benefit from improvements in volumes, given that we don't see the same upside in the oil market as we would in, say, the metals markets, where capex is still very difficult to commit from CEOs. There is a longer pipeline of development. We see still greater potential in the metals and mining side than we would in the straight oil sector. And And for that reason, we would, when it comes to oil exposure, prefer shipping. But as a fund, generally, we would probably have a much larger position in the actual mining sector, which will sustain superior margins for longer because of the time it takes to bring new projects on.
Another one of the asymmetrical supply-demand curves that we're seeing is in uranium. And you guys run the Geiger Counter Fund as well. So tell us a little bit about how things are developing on the supply-demand side, and as well as the next steps for carbon-free emissions.
Yeah, I'd say among the commodity sectors that we monitor, the uranium sector certainly is one which is, by virtue of being one of the most concentrated, now very interesting in that some 50% of global production was removed for 3 months of the year, longer in some cases, for certain operations. Whilst there's been a slight reduction in electricity consumption during the imposed lockdowns, if we look at the proportion of uranium production taken offline versus the amount of uranium used, even in slightly lesser quantities during the lockdown, the supply reductions have far outweighed the reduction in demand and usage. And we still see that utilities, particularly and perhaps more so in the face of fiscal constraints, will, as the US has outlined, see the reactor lives extended, and that demand will remain more solid than is perhaps expected. Whilst the EU is still debating and is a bit reticent, I think, led by Germany, to include nuclear in its carbon-free status, I think there is still very good reason to believe that it is going to form a major part of that. It's very difficult to see otherwise. These equities and this sector has been decimated since Fukushima, and we see some extreme potential for that sector to perform.
Excellent, Keith. Is there anything else you'd like to touch on as we wrap up?
I would say that, we look at the uranium sector for Geiger, that is now coming back into investor sites. That fund is trading at an 8% premium, and we're able to grow that one, which is, I think, I would say this, but I think it's the right way for things to progress. I think at the other end of the extreme, it is a little bit surprising that given the longer term potential for gold to hold its own value, we'll see how the dollar performs over the next year and longer. But, with the unprecedented levels of stimulus, with government spending budgets now way over the sort of typical Reinhardt-Rogoff, even 100% levels of spend and borrowing, there is a very good case for holding gold in the portfolio. And that fund trades at a 20% discount, which we think, in addition to the valuation opportunity of those investments in that fund, gives investors in our fund another degree of leverage into the gold price, even just holding its own. And I think we'll see that fund also rotate into the lagging performance of more silver exposed equities to capitalize on the sentiment of the gold performance, and potentially also benefit from the hope for improvements, I should say, in underlying industrial demand from the various sectors that I referred to earlier. In terms of CNR, I think we've got something like 28% of exposure to precious metals in that fund, and maybe there's a case for rotating some of that into silver. Equally, some of the gold might look to the likes of copper, which we still think is well supported given the amount of stimulus that has been pumped into the economies.